What are the alternatives to a reverse mortgage? What are your options? We spend a lot of time on this channel talking about reverse mortgages, but of course that's not all we do. As a full service brokerage, we have access to all of the different types of mortgages in Canada. And in fact, for 25 years, I have specialized in alternative mortgage lending, meaning great mortgages for people that can't qualify for a bank mortgage. And there are a lot of options out there. So that's what we're going to talk about today. Alternatives to reverse mortgages, whether they're from your bank or not from your bank. You've spent your whole life paying down your mortgage, building security, freedom, and peace of mind. Now retirement costs are climbing more than expected, and every month the bills get higher. Your house, once your biggest achievement, is starting to feel like a trap. You can't keep up with things, whether it's the roof, or the driveway, or whatever. Things break down and it gets harder and harder to afford to fix those things or make your home feel the way you want to feel in it. And when you hear about reverse mortgages, of course you wonder, what's this option like? Let's find out. Let's watch this video. But you also wonder, is that the only way to access your equity without selling it? Maybe it sounds appealing for a reverse mortgage. Maybe it sounds risky. Either way, it's not your only option. And in fact, the number one thing that we do right away is figure out whether reverse mortgage is right for you or if there's another option that's better and more suitable for you. And if there is, we'll recommend it. And if you want help, we'll help you go get it. Today, I'm going to talk about what other options are out there that are safe, practical, and often overlooked ways to access the value of your home without losing control of it. My name is Peter Fabry, founder of Rewind Mortgage, an information site and division of my licensed brokerage. I've been a broker for 25 years, specializing in alternative lending, as I said, and I help Canadians 55 and older navigate complex mortgage situations. And everybody's situation is unique. Believe me, I've never had two mortgages that were identical. If you'd like to check my licensing or background information, you'll find everything in the description below or on the website. So let's explore alternatives so you can make a fully informed decision about what's right for you and your family. First things first, let's look at why people consider reverse mortgages in the first place. Like, why are you watching this video? Before we talk about alternatives to reverse mortgages, let's understand why people turn to reverse mortgages in the first place. The hundreds of thousands of people in Canada that have already got one. Most Canadians over 55, they don't want to move. They want to age in place, stay in their home that they love, near their community, their family, their friends, their memories. But with higher costs of living and fixed incomes being so low compared to those costs of living, and limited borrowing options when you don't have a lot of income coming in, many find their retirement savings stretched thin. A reverse mortgage can relieve the pressure with no monthly payments, tax-free funds, and flexible access. So it's about accessing funds to stay where you want to stay. But a reverse mortgage is not right for everyone. Some people want to keep their estate intact, or they simply prefer other tools. And that's what a reverse mortgage is. It's a retirement tool. It's not a step backwards. So let's talk about alternative number one, the most popular alternative that comes to people's mind because people usually go to their bank when they're looking for money. And the first thing a bank will usually offer you is a home equity line of credit. And this is also known as a HELOC. It lets you borrow against your home's value and you only pay interest on what you use. One of the problems, people tend to use it. They rack it up. It's flexible. You can borrow and repay against it whenever you want, but there's trade-offs or gotchas. You need income and good credit to qualify for a HELOC. And the amount you can be qualified for a HELOC is dependent on how much income you make. So this differs from reverse mortgages where the amount you can get depends on how old you are, the value of your home, and your postal code. It has nothing to do with your income as long as you can keep up with your income taxes and your home insurance. So with a HELOC, there are a couple other gotchas, and the payments never stop. Even if you only draw $100,000, and let's say we use a rate of 7%, that's about $583 every month. It can be managed by some, but it's stressful for others. And you can't miss a payment, or you risk having your credit damaged, or losing access to the line of credit. Another thing that people forget is that the bank can change your credit limit whenever they want. This has actually happened a lot in 2025 and has been discussed by mortgage professionals on other sites who specialize in bank mortgages. Banks have started in this economy cutting back on the lines of credit limit that people were approved for. So literally overnight, you thought that you had access to a bunch of equity on your home, and the next day you don't have access to it, but you still have to make payments on the balance that you do have. So that's one of the gotchas that you have to be aware of. You have to make payments, and you can get surprises, whether the interest rate goes up, whether your limit gets removed. There are things to consider with those types of product as well. Now, for some people, they're great. You can manage the payment, or maybe you want to be able to pay off the whole thing quickly without a penalty. Maybe you only need it for a short amount of time. Could be perfect. Here's another alternative to a reverse: refinancing your existing mortgage. So let's look at a traditional refinance. This means replacing your current mortgage with a new one. You can do this sometimes to get a lower rate, or sometimes you can stretch out the amortization. So maybe you only have so many years left on your mortgage. You can stretch out the amortization, meaning you can put it back to, so let's say 25 years, which is what it probably was when you first got it. So let's say you've got a mortgage and there's only a few years left on it. You don't want to borrow any more money. Maybe let's say even the rate is exactly the same as today's interest rates, but you can stretch out the amortization, making the payments smaller. If you want to make higher payments, you can take use of prepayment privileges to bump up your payment. Every mortgage lender usually allows you to pay a certain amount, let's say 10, 15, or 20% of the mortgage balance off every year if you want to pay it down. So this is a different consideration, and it can be a good one too. So you're still getting a regular mortgage. Maybe you're getting a lower rate than a reverse mortgage. Maybe you can handle the payment, but you can lower the payment by changing the amortization, just as an example. If you still have solid income from investments or part-time work, refinancing can free up equity and lock in a predictable payment. You can refinance up to 80% of your home's value, minus any existing mortgage balance. The downside, again, you have to make principal and interest payments, which can strain a fixed retirement budget, which might be the whole reason you're looking at a reverse mortgage in the first place. The other thing is refinancing can come with penalties. If you break your current term early, you have to always check what the penalties are. And I always warn people, I'm not the only broker that warns people about this. Sometimes those mortgages with the absolute lowest rock bottom interest rates are the ones with the highest penalties. It's not just 3 months interest like in the old days. Nowadays they do what's called interest rate differential. So what this can mean, for example, is if rates have gone down from when you got your mortgage and you pay your mortgage back and the bank has to lend out the money to somebody else, they're going to be able to lend it out for less interest rate than they lent to you. They want you to pay the difference. That can be a lot, especially when they're adding up the interest rate differential over the entire remaining life of your mortgage. You have to always understand what you're signing and never just look at the lowest interest rate. Here's another alternative to refinancing or a reverse mortgage. You can downsize or relocate. You can sell, you can get a smaller home, condo, move to a different city, to a more affordable market. This is one of the cleanest ways to turn your home's value into liquid cash, no debt involved. It can reduce your property taxes, your utilities, your maintenance costs, or even the time to maintain your property, but it's emotional. Some folks are totally ready to do it, leave their memories behind, look fresh to something new, some other place, but for some that trade-off is not worth it. For others, staying rooted in their community matters more than anything. Moving and selling is a last option, like no way, never. So it's really a preference. What do you want to do? Do you want to stay where you are? Or are you open to going somewhere else where you can pocket some money and reduce your cash flowing out every month? Here's another alternative: selling a portion of your home. A newer concept is the concept of shared equity. It's called a shared equity agreement or home co-investment. It goes something like this. And there's two different types of this. There can be through somebody you don't know, a professional company, or it can be through a family member. I'm going to go over the both of them here. So in the first option, an investor can give you a lump sum in exchange for a small share of your home's future appreciation. Your home is going up Let's say they lend you 5% of the value of the home. If the house goes up in value, they want their 5% portion of that appreciation. And so there's no monthly payments, but when you sell or refinance, the investor gets their share of the gain on the property. It's not a bad deal if it helps you stay in your home and you're looking for no payments, and sometimes it can be a more flexible option. But it does mean sharing some of your future upside with someone else, someone that you don't know. These agreements are fairly new in Canada, so always read the fine print and absolutely make sure you get independent advice from your lawyer. But another alternative in terms of shared equity can involve family. A growing solution is a family participation where adult children can help their parents access equity, and it's protected by family. This could mean a private family loan secured on title, or co-signing a small mortgage to free up funds. Or it could mean co-ownership, where the children buy a part of the property now to help the parents stay where they are, and it's really like a planned inheritance. It's efficient. This can be done through one of the most common types of home ownership in Canada called tenants in common, where each person owns a percentage of the property, and it's defined right within the deed of the property. Let's say kids buy 10% of your property, they own a 10% stake in the property, you get the cash. There's no income tax owing. Just for reference, the other type of home ownership that's common in Canada is of course called joint tenancy. And that's where if one person were to pass away, the house automatically gets transferred 100% to the other owner. So tenancy in common is, well, it's common. If handled properly, it can keep wealth in the family instead of paying interest to a bank. If handled poorly, it can strain relationships. So always make sure there's a formalized agreement, a legal agreement. Basically, you want to make sure that neither party feels trapped and that the agreement spells out how things will be handled if one person wants out and how they want to sell their equity in the home. The last thing you want is where someone needs the money and they can't access it, or someone wants the money and they force you to sell the home so that they can get their equity. You want everything spelled out. Get your lawyer to help you with that. So let's talk about a real case study. We'll look at two examples. First, Linda, age 68, from Victoria. She wanted to renovate and help her daughter with tuition. She refinanced her mortgage, kept the payments low with a 5-year term, and still maintained full ownership. Another scenario, Paul and Diane, age 75 and 77, from Ottawa. They didn't want to make payments, not at all, but they also didn't want a full reverse mortgage. Instead, they did a small shared equity plan for $100,000 with one of the kids. No payments, partial repayment later, different needs, different solutions. That's the point. There's no single answer. It's what's right for you, what's suitable for you and your needs. I'd love to hear from you. If you had to choose right now, which option feels the most realistic for your situation? A reverse mortgage, a regular mortgage, a HELOC, or shared equity with, say, a family member? I'd love to know. Type your choice in the comments. I'll be sure to reply with my thoughts on how that path might work for you. You can contact me privately, of course, at any time and ask me questions on how to make any course of action work for you related to mortgages. Here's my advice as someone who's worked in mortgages for 25 years. Do not rush. Compare every option. Even if one sounds convenient, it might not be the best one. Talk to a licensed broker who works with both banks and alternative lenders, including reverse mortgage lenders. They're not as easy as they sound. You want someone who's independent and does not work for a lender, does not sell only one lender's products. You want to know what your options are, and the only way to get that is from someone that isn't tied to one particular lender. My next piece of advice, ask hard questions. What are the long-term costs? Can I still move? Can I refinance later? What happens if I live longer than expected? What happens if my income dries up? These are important questions, and you need to talk to an experienced professional. So let's recap. We've explored 5 main alternatives to reverse mortgages: HELOCs, refinancing, downsizing, shared equity, and family-assisted plans. Each comes with trade-offs in terms of cost, control, or flexibility, but the best one is the one that fits your life. If you'd like a personalized comparison showing how much equity you could access through any of these options, visit rewindmortgage.ca or contact me through one of the links in either this social media platform or posted on my website. I promise your call or your emails or texts will be confidential. We can talk about real life examples, calculators, and questions to help you understand confidently and talk confidently with your family about your options. I'm Peter Fabry with Rewind Mortgage, a division of Brokerate. Thanks for watching. Take care of yourself, take care of your home, and remember, if you like this video, please do hit like or subscribe. Stay tuned for the next one if you want to watch more. Bye for now.